It's 3 p.m. live from our studio in New York City. I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live. And here's what we're watching this afternoon. The battle between growth and value. Tech stocks are on track for their best month since July of last year. And Wall Street is betting that rate cuts are on the horizon. We will hear, though, from one investor who says portfolios need to be more balanced. And she'll tell you where the opportunity is.
Plus, the holiday shopping season kicking off with a bang. Shoppers turn out in stores and online, hitting a record high, but shoppers were looking for bargains. The level of spending roughly in line with last year, according to the National Retail Federation. We're going to break down the numbers and what the rise of buy now, pay later says about the state of the consumer.
And Amazon is launching its own chatbot called Q. The tech giant ramping up its competition against Microsoft and Google, especially when it comes to workplace productivity. Amazon also deepening its ties with NVIDIA while announcing a new AI chip itself. We've got the details later this hour. Let's get you up to speed on the market action right now. We have stocks that have been bouncing around once again in kind of a tight range here. Right now, all three major averages are in the green, but not by much. The Dow just up 100 points, 0.25%. The S&P up just about 2.5 points, and the Nasdaq up by 0.1%. Utilities and real estate, the two leading groups today. Interest rate sensitive sectors, I will note. We'll talk more about that in just a moment. And healthcare is the lagging sector on the session, along with financials.
All right, and we are taking a closer look at the bond market as well here. Yields coming under pressure after Fed Governor Chris Waller suggesting the Fed's rate hiking cycle is over and Wall Street is betting on rate cuts. Treasuries are extending this rally, Julie. Look at the 10-year. We're now at 4.338. Wasn't so long ago, of course, we were at 5%. Looking at the 2-year, that is at 4.738. And of course, investors, they become more comfortable with this idea. The rate hiking campaign is over. That cuts are now in the pipeline. And we did have some Fed speak. So we mentioned Governor Christopher Waller. Now, he was making headlines saying he's increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%. So that was kind of, I think, sort of giving investors confidence that how they're thinking about the next year ahead. It makes sense. That's what the market expects. On the other hand, though, we had some kind of mixed messaging. We had central bankers perhaps kind of pushing back on that market narrative. You heard Fed Bank of Chicago President Austin Goolsbee saying, yes, inflation is cooling, but we're still not at that Fed 2% target just yet. So maybe some mixed messaging here from policymakers.
Yeah, at the same time, it didn't seem like there was anything that was said by them that dissuaded the market from its narrative, or at least not significantly, right? Or else you would have seen something different from the Treasury market today. A couple of other things to mention. There was an auction of 7-year notes today. That was a $39 billion auction. It was a little bit weaker than anticipated, and there was some chatter in the market that perhaps the move that we saw in Treasuries today in reaction to some of the early Fed speak was maybe a little bit overdone, then didn't set the market up well for the auction. Be that as it may, the longer-term trajectory and forecast for the Treasury market is still pretty bullish, meaning market participants think prices are going to continue to move up and perhaps yields are going to stay here or continue to move down. There's a weekly survey that's done by JP Chase. They've been doing it since 1991, and they found record bullishness in this week's survey, which is pretty astonishing here. 78% of active clients were long relative to their benchmark, their treasuries, up from 56% the previous week. So a lot more participation in the bond market here. And that is a really big week over week change in that level of bullishness. It's pretty interesting.
We are also, I should mention, just a few days out now from the blackout period where you traditionally, you would not hear central bankers speaking publicly, but we've heard a lot from policymakers. So maybe the blackout period's okay, Julie, for a bit.
Maybe it is. I don't know that anything would sort of, if they wanted to communicate something that was a change, they would likely do it before the blackout period because, as we've discussed many times before, the Federal Reserve does not like to surprise the market. So it would be unusual to see some kind of dramatic change in messaging on decision day itself these days.
For sure.
But we'll see. Well, the year of the landing, that's what Bank of America is calling 2024. Strategists at the firm say they expect disinflation to continue globally, allowing central banks to cut rates midway through the year. B of A also saying the S&P 500 will end the year at 5,000, an all-time high, not because of rate cuts, but because of corporations' resilience in this higher rate environment. Joining us now, Oh-Sung Kwon, who is Bank of America U.S. and Canada equity strategist, who helped put together that outlook for next year. Thanks for being here with us, Oh-Sung. Appreciate it. So when you look at next year, whatever the landing is going to be, is your 5,000 call sort of landing agnostic, if you will? You know, unless it's really outside the variations of sort of weak recession to, weak gains, I guess, in the economy.
Yeah, thanks for having me today. Great to be here. So we are forecasting 5,000 on the S&P 500 for next year, and our base case is basically soft landing in the U.S. economy. The reason why we're bearish is not because we think the Fed is going to cut aggressively, but rather because of what the Fed has done already in terms of controlling inflation down, not putting the economy into a recession. And during that period, companies have adapted to this higher interest rate environment. Earnings started inflecting. And in fact, we think that Q2 was the bottom in terms of this earnings cycle. And we think earnings are likely to accelerate into 2024. Positioning is still pretty bearish, and we think we are past the peak macro uncertainty in terms of the Fed, inflation, and rates. And I think that sets up pretty well for equities into 2024.
And Oh-Sung, I don't know if you heard, we were just talking about the Fed expectations there. The market clearly expecting here that the Fed's done hiking, cuts are in the pipeline next year. Is that your base case, Oh-Sung, as well?
Yeah, so our economists are forecasting a couple of rate cuts starting in mid next year. But what we highlighted was that you don't want, as a bull, you don't want a Fed easing cycle for wrong reasons. Historically, a Fed easing cycle combined with credit tightening cycle has been the worst environment for equities. So if it's a recession-driven Fed easing cycle, then it's more bearish than bullish. And you almost want soft landing, no recession, credit market staying healthy, the economy staying healthy, and with disinflation. And we believe that earnings can continue to accelerate despite GDP potentially slowing down. And if that's the case, that actually has been the best environment for equities when GDP is slowing down and EPS is accelerating. That doesn't happen very often, but that's our base case actually. And if it does happen next year, that sets up very well for equities in 2024.
And all of that amidst what, at least in the first half of the year, is likely to still be a relatively high rate environment. So I want to dig a little bit more into one of the other theses in the outlook, which is that companies have adjusted to this higher rate environment. How have we seen them adjust? What are some examples, and are they going to continue to need to do that, or are the adjustments they've made thus far, have they incorporated the higher rates?
Yeah, so first of all, the reason why we haven't seen a recession, or one of the reasons why we haven't seen a recession in the U.S. economy, is because a lot of debt is currently fixed, whether it be corporate debt or consumer debt. When it comes to corporate debt, 75% of total S&P 500 debt is long-term fixed. So it's a lot more manageable than prior hiking cycles. There are two reasons I want to say that earnings were in a recession when GDP wasn't. One is because cost was a little bloated, especially after the huge earnings upcycle that we saw post-COVID. So a lot of tech companies and other companies had to cut costs to get out of that earnings recession. And we saw signs of that happening in Q3. Q3 EPS was up 4%, a lot better than down 6% that we saw in Q2. Earnings grew 4% when real sales growth was still down 2%. So that basically speaks to companies' cost management and cost efficiency. The other reason why earnings were in a downturn when the economy wasn't is because the big shift that we saw from goods to services. When it comes to earnings, S&P earnings are 50% goods for 50% services. When it comes to the economy, goods are only about 20%. So the big shift that we saw from goods to services, that had disproportionate impact on earnings than the economy. our view is that that's going to reverse. That's starting to reverse. That pent-up demand that we saw in services, that's starting to moderate. We're starting to see some signs that destocking cycle is over in goods. Inventories are a lot healthier. That's what a lot of retailers are reporting these days. So if that's the case, there's been a very strong correlation between the spread between goods consumption and services consumption versus how earnings do versus GDP. And if goods start to outpace services in 2024, that's the recipe for earnings outpacing GDP next year.
And Osung, another variable I just want to get your take on. We're heading into an election year here, Osung. How does that play into your outlook, if at all, for 2024?
Yeah, historically, election years have been positive years for equities. It's actually been the second strongest years in terms of the presidential election cycles. And the Fed is done hiking, and in an election year, I think the Fed is probably going to be more careful on what they do. And if that's the case, we think the economy can handle the current level of higher rates. If that's the case, soft landing is our base case, and equities can work in a soft landing scenario.
All right, Osung, thank you so much for joining us today. That was Osung Kwan, Bank of America U.S. and Canada equity strategist. The 2024 IPO market looks like it could already be heating up, with the fast fashion retailer Shein expected to lead the charge. Several sources are reporting that the Chinese-founded retailer has filed confidentially with U.S. regulators to go public, and Bloomberg says Shein will be seeking a $90 billion valuation, making it the biggest IPO since Alibaba almost a decade ago. It's one of many big names that are floated as potential listings this year, which also includes Skims, Reddit, and Rubrik. To break this down, we have Greg Martin of Rainmaker Securities and Brian Lynch of Equity Zen. Guys, thank you so much for joining us. Greg, let me start here with you. I think, Greg, we actually caught up in September, and then we were talking about the IPO window, Greg. It was ARM and Instacart and Klaviyo. As we look down at 2024, Greg, how confident are you that IPO trickle maybe turns into a flood here?
Well, a lot of what we just heard is very positive for the IPO market. The stabilization of rates, the view that we might have a soft landing, all is good news for the equity markets, and, good news for a potential reopening of the IPO markets. Now, we haven't seen very good performance from some of the IPOs that went out in September, other than ARM. ARM's the only one that's trading up in sort of the tech high growth areas that I cover, and ARM is kind of unique in terms of its AI focus. But I do think that the environment is much more positive. The VIX is at a 5-year low, and there's a lot of positive tailwinds that could signal a potential reopening. But I do still think we're going to have to test the market first. The market's going to want to see positive performance in these new issuances before we see what I would call a true reopening of the market.
Yeah, and as you point out, the first test didn't go so great. So, Brian, I feel like we're at this point where we were before, right? Where we were looking ahead to all of these potential big issues coming out, and it was going to crack the IPO market open again. And that's not what we saw, because I guess the test failed. What do you think? Is the test this time going to work?
I think it's a great question, and Greg touched on some of those macro points that would suggest that this is a good market. You also have GDP that's strong, job growth that's strong, a likely end of rate hikes or even cuts coming up. So from a macro perspective, you would think that now is a good time, but I think a lot of companies that are sitting on the sidelines are waiting for one or two blockbuster IPOs to happen, go well, kind of warm the investor market and encourage others to follow. So these first companies that go are choosing to be leaders and hopefully be the ones to do that. So Shein being one of these companies, looking at an $80 to $90 billion valuation. The question is, can they be the one to prove that, investors are interested in IPOs, given the growth they've had and the success of their business? They could be that company, but there's also a lot of hair that comes with their specific, business model and some of the concerns that have been raised.
And Greg, Brianne there just mentioned, companies waiting on the sidelines, and you're the perfect guy to ask this. What is the pipeline like right now, Greg? I mean, are there a lot of startups, waiting in the wings right now, ready to take that public market plunge?
Well, the backlog is very deep. There's a lot of companies that were preparing to go public at the end of 21 and expecting a similar year in 2022. So there is a very deep pipeline of companies that would like to go public for a variety of reasons. Some is just a lot of liquidity needs with investors. Some is just sort of funding the continued growth of their business. And obviously we saw the last pretty much 2 years, the IPO market being dead. So there's definitely a fertile pipeline. But I do think that it's going to be, there's sort of a phase approach that I think we're going to see. And that's the really high quality companies that are going to test the market first. And I think if we start to see good performance in new issuances and strong investor demand, then the floodgates may open. But I think we're a quarter or two away from seeing that, because I think the market really is taking a wait and see approach as to how these new issuances perform.
And then there's something related that I want to ask both of you. And Greg, I'll start with you on this, because both of you do have insight into that private market, pre-public cohort. Is there any correlation? In other words, are you seeing, for example, down rounds? Are you seeing companies that are having trouble raising money? And does that tell us anything about the reception that they might get publicly? Greg, I'll start with you, and then Brianna, if you can answer the same thing.
Yeah, I mean, at Rainmaker, we see a lot of flow on our platform, and the private markets have been very, very chilled the last 18 months to 2 years, and it's still a struggle for companies to raise capital, and the ones that do are seeing more terms, more draconian rounds. We are not seeing a lot of up rounds. I mean, there's some exceptions, of course, maybe in the AI space, for example. But in general, it's a very tight private financing market. And in the secondary world, we've seen substantial discounts, from the highs in 2021. So that doesn't portend a strong, demand in the IPO market. And some of the biggest challenges that these companies have is that their last true round of financing was done at such a high price that it will be a struggle for them to be able to see that price or anywhere close to that price in the IPO market. And that creates all kinds of other issues around how do you convert a preferred to common when you're looking at a potential IPO down round of 33 or 50%. So it's going to be interesting to see how that's navigated.
And Brianna, I want to get your take on a separate issue here. The boom of interest in AI continues. You saw that with some of the recent names that went public. ARM, for example, making the case to investors. It's a smart way to play that theme. Is that simply, do you think, Brianna, is that part of the story you have to tell now if you're going public? Does it feel like that better be a core chapter in the story you're telling investors?
I think anything with AI adjacency is going to get a little bit more buzz. Whether or not it's a real part of their business or something that they're just throwing in the S1 a few times, to check that box is a different story. And investors will be the ones to judge if that actually is a meaningful part of their business or a driver of their business. But we are seeing in the private markets on EquityZen's platform that AI and machine learning companies are the most in-demand companies amongst our investors. When it comes to these companies IPOing, though, a lot of them are still relatively young, so we don't expect to see a pure play AI company likely test the markets next year. We could be wrong, but just given the fact that so many companies are waiting 10 to 15 years to go public, it may be a while before some of these pure play companies are available to public market investors. And in the meantime, investors will be looking for that AI adjacency to kind of, have that mix in their portfolio.
All right, great to see you guys. Thanks to you both. Greg Martin of Rainmaker Securities and Brianna Lynch of EquityZen. Appreciate it.
Thank you.
We're just getting started here on Yahoo Finance Live. Coming up, year in review. Bob Iger gave insight into the work he's done at Disney since retaking the chief position last November, as well as the priorities for the future at the company's town hall. Yahoo Finance's Alexander Canal will have the details. But first, did the so-called resilient consumer show up for Cyber Monday? We've got fresh sales data for you on the other side of the break.
Shares in PDD Holdings, the parent company of Chinese e-commerce brand Temu, spiking today after reporting explosive growth in its third quarter. Revenue up 94% year over year. So this one, we got a revenue beat, Julie. Looks like nearly $10 billion. Net income jumped nearly 50%. And the story here does seem to be this shopping app. Temu competes, obviously, with Shein, with Amazon. And I guess you could argue, listen, time of some economic certainty here, certainly in China. If you're selling deeply discounted items, you can win over a few consumers.
I mean, deeply. I went on this thing today. I'm laughing because it's laughable how cheap this stuff is. And I was joking with the team, like, how quickly does this stuff just sort of disintegrate after you buy it? We've gotten some variability in our responses, but the point is here is that PDD's Temu is growing rapidly. They're not sharing a lot of metrics around Temu itself. That's a common theme that investors and analysts want more detail, more color on Temu itself. But what seems clear is that it is growing at a faster pace than its rivals. So I do find it interesting that we get this PDD numbers a day after all of these reports that Shein is indeed talking about going public, because it seems like this is going to be one of its, and already is, one of its main competitors, but something that we're going to be watching really closely here.
Yeah, and you got to point out the stock performance too, which you hinted at. I mean, U.S. listed shares here, they're up about 70% now this year. Compare that with Alibaba or JD. I mean, they're both well in the red. So investors seem to bet this is still a smart play and that they can take share.
Yes, most definitely. Let's talk about another e-commerce company. That is Farfetch, the luxury e-commerce brand. The shares are surging after the Telegraph reported the company may go private after a troubled New York Stock Exchange listing. Founder Jose Neves reportedly in talks with advisors at JP Morgan about this. This company went public back in 2018. The stock has not done well since then.
No.
And so there's been some different talks about what he can do about it. And I guess this is one of the latest things that's being reported on.
Yeah, I mean, you mentioned the stock, even with the bump today. I mean, it's still down about 50% this year. Most analysts, looks like on the street, have a hold. They do, are expected at least to report earnings, I believe, tomorrow. So maybe with that news, maybe we'll get a little bit more color and insight about what's going on here.
Yeah, and Farfetch may be partially a victim of some of the luxury unevenness that we have seen this year. But even before then, the stock was sort of declining here. So we'll keep an eye on it and see if there's any more news and headlines on that potential going private.
All right. And finally here, Shopify has been one of the big winners of Cyber Week, with its merchants reaching a record $9.3 billion in sales, 24% increase from a year ago. Piper Sandler, though, seems to think this is all too good to be true. And that's the story here. Piper Sandler analysts, they were at neutral, Julie. Now they go to underweight. So a sell, cut their target to 56. This is the only sell, it looks like, by the way, on the street at this point. And the big issue here is valuation. No surprise, the stock's monster run in 2023. It's up about 110%. Piper's saying the current shares hold an untenable valuation. That's the issue.
Yeah, as you say, it's the only sell on the street. There are 25 buys and 26 holds on the stock, and it looks like the 12-month average price target's around 69. So below where it is right now, as most folks have a hold on the stock. But, you know, there was so much enthusiasm yesterday in the wake of Black Friday and Cyber Monday and the role that Shopify played in all of those transactions. And so now a little bit of a come down, as Piper says. It's gone too far, too fast.
Yeah, because
what is it, 130% this year, something like that?
I mean, it sounds like they still like the story, right? I mean, they talk about the e-commerce penetration, they talk about the market share opportunity, but maybe just, in their opinion, a bit too much good news priced in now, at least for them.
I guess so. All right, let's talk more about retail, though, here. Cyber Monday sales hitting a record $12.6 billion in the U.S., rising 3% year over year. That's according to Salesforce. And AI, as well as the buy now, pay later option, played a big role in yesterday's sales and the weekend sales, for that matter. Here to help us break down the data is Salesforce Vice President and General Manager of Retail, Rob Garf. Rob, thanks for being here. What sort of, you know, we've been talking a lot about the volume of sales that were done here. What are some of the trends that you're seeing? What are some of the things that maybe changed from year to year or accelerated that you can talk to us about?
Yeah, absolutely. As you mentioned, we saw a really healthy 3% year-over-year growth on Cyber Monday. And that's from the resilient shopper. They are certainly doing their research. They are being patient. They are being diligent. And they didn't bite on early holiday sales. They waited until they saw discount rates hovering around 30% over the holiday weekend, and they actually stepped up and they purchased. The most interesting point about all of this growth, it's from increased demand. For the last 5 quarters, the growth has been almost all from increased prices. So the shopper is looking for deals. They're being very surgical, and they came out to buy this holiday week.
And Rob, let's also look ahead here. Listen, it sounds like it's been a relatively strong 10-day period. Do you see it continuing, Rob?
We do see it continuing, though. We're not changing our forecast for the entire season. So, sales got pulled in back to the peak days of Black Friday and Cyber Monday, and they were taking market shares from the bookends earlier in the holiday season and the late stage of the holiday season. But every retailer I'm talking to is really positive. Nobody had unrealistic expectations for growth this holiday online. So they're really pleased with what they've seen. They're looking forward to coming out of this holiday season with really good footing around profitability and inventory levels, and they're looking for next fiscal year to get back to growth mode.
But surely not everybody can be doing well, Rob. I mean, there must be some that are doing better than others. We've heard survey data, although we know that hard data doesn't always match up with survey data, but survey data that people are going to be a little choosier this holiday season. They're concerned about the economy. They're still concerned about inflation. Are there any areas of weakness that you saw?
Yeah, absolutely. You're right. Consumers are making trade-offs. They're taking control of their household balance sheets. And, they're looking for certain categories. So first, on the strong side, we are seeing active apparel, active footwear looking really strong. Health and beauty is coming back as well. But we're seeing a little softening in luxury. This has been the most resilient category through and coming out of the pandemic. And we're starting to see a little bit of softening, particularly at that aspirational luxury level. Consumers are starting to feel the pinch and having to make trade-offs. Consumer electronics as well. We saw a huge roar in that over the pandemic. Everybody got a monitor for their in-house workspace, and that's cooling off a little bit as well. In general, though, we're seeing people focus on value. Resale is really big, actually, this holiday season. We're projecting 17% of all gifts will be from the resale market. These people are focusing on value. They're focusing on vintage, and you know what? They want to save the world as well, especially younger generations.
And Rob, switching gears, I want to talk about AI, just the boom of interest in artificial intelligence. Rob, how are you seeing that technology being leveraged right now to help consumers?
Yeah, I can't have a conversation these days without talking AI, and it's having a big influence this holiday season. We're forecasting through the whole holiday online, so November and December, it will influence $194 billion globally. And, it's focusing on things like targeted offers through email, product recommendations. When you're on a website, you might like this type of prompts. And then we're seeing customers of ours lean into generative AI for service. Gucci, as an example, through their Gucci 9 service center, is looking to create scale, create more consistency in the interactions, and ultimately connect products to the consumers by really arming their service agents with service replies empowered by artificial intelligence from our service cloud.
It's so interesting, Rob, because I think when sort of ChatGPT or large language models broadly first started coming to the fore, at least personally, I was envisioning it more in that chatbot function. But I know that, as you mentioned, there's a lot of sort of behind the scenes usage for AI as well in terms of tailoring. How do you sort of program, especially within retail, to tread that line between being helpful and annoying for customers?
Yeah, absolutely. There's this interesting balance happening between the customer experience and operational efficiency. We're definitely seeing automation, as you talked about, in chatbots. And actually, chatbot usage grew by 35% year over year. So people are going to that around, where's my order? Where can I find the product? And retailers are really automating and scaling that experience. But they're also using it to personalize the experience. It's really important to point out, though, an AI strategy is as much about a data strategy. So you must understand who your consumers are, their profile, their preferences, understand what products they like, and be able to really activate that through artificial intelligence to provide personalization. And, one customer of ours put it this way, AI is the new UI, the new user interface. So think about, rather than just searching a website, now you're going to be talking to an agent that's going to be able to help you get the product you want more effectively, more efficiently, based on how the consumer knows you shop and what you're likely to buy.
Rob Garf from Salesforce. Rob, thank you so much for joining us today. Appreciate your time.
Thank you. Happy holidays.
You too. Big tech stocks dominated market moves in 2023, but what about opportunities for investors outside of tech? How to achieve growth across broader markets? That's coming up next.
Gold prices rising for the fourth straight session, hitting a 6-month high. Jared Blickery here with a look at what is driving those gains. Hey, Jared.
Hey, Julie, we've been here with the price of gold a few times before. Is this going to be the breakout? Right here, I have a chart going back to earlier this year of gold with the inverse of the 10-year real yield. So this is showing how bonds, at least the inverse of the real yield, were correlated. And then we had the Gaza incursion. Gold kind of decoupled and it hasn't looked back. Interesting to note another correlation, which is gold with the US dollar. Here I have as a proxy gold versus a euro. Why? Because a euro is inverse, moves inversely to the dollar. So when this is going up, the dollar is actually going down. And what we see is gold has been moving almost in lockstep, at least directionally, with the inverse of the dollar. And with all the talk about the Fed potentially being on hold, that has given the dollar's rise a pause. In fact, it's been sinking during the month of November, and that has been a tailwind for stocks. Also, I'd note that big drop-off in rates, that has also been supporting the case for gold because gold does compete for other things in terms of interest rates. Let's go to our futures heat map, and I'll just chart the raw price of gold. This heat map shows all our commodities over the last 2 months, and gold here is on the top line, up 10%. Now, let me just put a 5-year chart. I said gold has been here before. Well, that's because it's been above $2,000 an ounce 4 different times. 1, 2, and it's hard to see here, but 3, 4, 1 month apart. And it looks like now finally on the move to break out. And if we did have the dollar, I guess, agreeing with it by backing off and continuing to stay on its downward course along with rates, that would support the case for higher gold just on a technical basis. And given the length of the consolidation here, we're talking more than 3 years, we could easily see a big pop to the upside. But is this going to be the time, or is it going to be 1 month from now? That's the trick with some of these long-term charts. The timing gets a little bit difficult, but nevertheless, the setup is here.
We will be watching that setup to see what happens. Thanks, Jared. Well, growth stocks still have been dominating Wall Street gains this year, thanks in part to artificial intelligence. Our next guest says there's opportunity in growth names outside of the tech sector. Joining us now, Jennifer Grancio, TCW Head of Global Wealth. Great to see you. Thanks so much for coming in. And this is obviously a theme that we've talked a lot about this week, that the mega cap tech stocks have just been dominating. But your bag is sort of looking outside of that at other things here. So I guess, first of all, tell us your methodology and why you want to look outside of that mega cap growth.
Yeah, thank you. I would be happy to do that. And if you think about it, everybody is so invested, and everybody's portfolio is so invested in tech and growth at this point. We think that it's always hard to time the markets. You can't be in cash vehicles forever. And so when you look at the equity portfolio, we're seeing huge transformations in the market. So we're seeing a transformation around energy, which is sources of powers, but also efficiency. So planes are getting more efficient. If somebody can manufacture a plane that's more efficient, they have huge pricing power and they have huge kind of opportunity to drive up the stock price. And so we run a range of strategies that are looking at helping people make money outside of that core tech portfolio, particularly as we look at one, transformation of how we use energy and power, and two, reshoring and this huge boom we're having in manufacturing in the US.
In commercial aerospace, that's one area. Explain that thesis to us.
Yeah, absolutely. And so if we think about how much we've invested or haven't invested, frankly, in the last decade in certain areas, commercial aerospace is one of those areas. So two investment opportunities. One, the planes we have up in the air today need a huge amount of maintenance. I think we've had 3 million people traveling just on Sunday. Highest travel day ever was this past Sunday. So air travel is coming back. Planes need to be serviced. So huge opportunity in names like GE that are actually manufacturing and repairing. And then if we look forward, there's a demand from consumers for efficiency. So new planes, Airbus's new planes use 20% less fuel, which is a huge savings and a huge edge, therefore, for companies that are buying the Airbus plane. So that's one of the themes that plays out in our portfolios.
Whenever we talk Airbus, I got to ask about Boeing too. So implied then is the idea perhaps that Airbus is doing a better job at this than is Boeing?
That's our thesis.
Okay, and just because that they are looking more to the future of having these more efficient planes?
The future and also how they run their business. So, Airbus is a business we think is very well run. We're active managers, so we run NetZ is one ticker, SUP is the other. They're very concentrated portfolios, and so we've known these management teams for a long time. In some cases, like in the waste management space, we own a couple of names. In the case of aerospace, we think Airbus is the one to hold.
And what could then Boeing be doing differently?
I think it's a combination of how they've run their business historically and how capable they are in terms of delivering in a reliable way from a forecasting perspective so that we can see that stock grow.
Let's talk about waste management since you touched on it. And this is an interesting one to me when I was reading your notes in advance of this, because you've always been focused on this sort of infrastructure play in the United States, right? But then, where does all the garbage go? Which is something I hadn't thought about. When you're doing these big projects, in other words, there's a lot that has to get hauled away. Is that what's going on here? Are these companies going to benefit from that?
They're going to benefit hugely. And so if you think about the market environment we've been in overall, it's been inflationary. These companies, particularly Waste Management and Republic Services, have dealt with that well. So they're coming out of this inflationary environment with good pricing power.
How have they dealt with that well? By raising their prices?
By having control of their prices and coming out of the current environment with the ability to increase prices further. So we start with that's good from a fundamentals perspective. And then if you look at this boom in manufacturing and reshoring, the country, if you look at a picture of the country, it's lit up like a holiday tree with mega projects up and down. And so when you do huge construction projects, only these huge waste companies can deal with the complexity, and in some cases, waste you need to handle very carefully from this huge boom in manufacturing. So they're huge beneficiaries there. The other thing we like, and the way we look at investments, is the intersection between different things we have going on. The garbage companies also have huge landfills, and each of them are building amazing businesses where they effectively are taking methane, carbon dioxide, they're recycling it, and they have over 60% internal rate of return on brand new businesses where they're generating natural gas. So very attractive across good fundamentals. They're well positioned for this huge boom in manufacturing, and also they've got some creative upside on the new sources of energy.
And just a broader question too, Jennifer, about ESG investing. It just became so politicized, Jennifer. How do you think that happened, and how do you think ESG investing and the strategy just sort of evolves from here?
Yeah, I think my view on that and the firm's view on that would be the E environmental, S social, G governance. That was always meant to be risk data. So from an industry perspective, shame on the industry for naming products what were supposed to be underlying risk data. And so the way we think about it is we look at the underlying risk data on every company. And if a company has an opportunity to kind of beat out a competitor because they can manage a risk better, that company should outperform over time. So we think about it as we're a performance investor, and we use the data and we're giving you alpha in return. And then there are other people that have a strong view on values, and that's great. You can always screen a portfolio in line with values.
Another sort of framing question, a different framing question. We began this conversation by saying, where can you find growth outside of tech? Do you think about the picks that you talked about as growth stocks? Are they value stocks? Like, how do we sort of get our hands around?
Yeah, the way we would think about it is we're always looking for companies that grow. So if you were to look at our portfolio, it probably is a blend portfolio that's a little bit more on the value side. But if we're right, that will be a growth portfolio over time. And so we're not looking for things that we don't think will appreciate. We're looking for things that are undervalued now and we think will have strong appreciation. And a lot of these industrials that we talked about, and all of those different businesses, many of them are categorized as industrials, all of them have very strong fundamentals, and we think they're underpriced today. So today it looks a little bit more value. We think we're right, and they will be growth over time.
All right, Jennifer gave us a lot to think about today. Thank you so much for joining us.
Thank you.
Appreciate it. And coming up, Bob Iger addressed the future of Disney at today's town hall. We're going to have those details coming up next. Disney has faced a multitude of challenges since CEO Bob Iger stepped back into his position late last year. Today, admitting during an employee town hall that his return has been more challenging than he anticipated. Yahoo Finance's Alexandra Canal listened in. So, Allie, what were the big takeaways?
Well, at the end of the day, Bob Iger says he's optimistic when it comes to the future of Disney, despite all of these challenges, and there's certainly been many. We have the stock trading near multi-year record lows, the park business is slowing, linear television is declining, streaming still not profitable, and then on the film side of the business, there seems to be more misses than hits. So Bob Iger says that he is optimistic moving forward because Disney as a brand is a strong one. He also said they've spent the past year fixing a lot of the problems, and now they are moving on to the building phase. And part of that building phase is going to be really honing in on all the different components of their business, all the different assets, and really determining what the long-term value is there, especially when it comes to future growth opportunities. We know Bob Iger has hinted before that he's not opposed to a little bit of M&A. He said linear networks open to all options there, but he sort of downplayed those comments today, saying that, they might be part of the Disney strategy moving forward. Dana Walden, who's the head of Disney Entertainment, she actually said linear networks are core to the streaming side of the business, and that seems to be what's dragging down the stock right now because investors, they sort of want to see Disney begin to offload some of those assets. But according to these officials, what we heard today from this town hall, maybe not so fast. So we'll have to wait and see if there's any more M&A chatter there.
Yeah, that's really interesting there. And Iger, has definitely kind of gone back and forth on a couple of things since he took over. I mean, I think of him in my mind as such a decisive guy, but obviously he's sort of reading the room a little bit perhaps on some of these issues, although this is not what the market wants to hear. How does all of this line up with what we are hearing on the activist side when it comes to Disney and what we know, although I don't know that we know a lot, about what the activists want exactly?
Yeah, and Bob Iger, he said he hasn't heard what Nelson Peltz, he's another activist investor. He came back from the dead, it seems like, fighting for more board seats there. Bob Iger hasn't given us too much on what he's asking for there, but I think you can go back to the stock price, really. That's what investors are focused on. That's what these activists are focused on. And Bob Iger has said he's focused on the shareholders as well and creating some of that shareholder value. Now, the easiest way to do that is potentially selling off assets, but you also have to take a critical look at your costs, a critical look at the amount of employees at the company, which Bob Iger has done. I mean, he's laid off a ton of employees. He actually increased the cost-cutting measures by $2 billion after saying he was going to slash costs by $5.5 billion in February. So he's committed to a lot of changes. Now, entering into 2024, I think a big question is going to be how will these changes be reflected on the operation side of the business? And, investors did cheer the last earnings report. Analysts said Disney got its mojo back. There seems to be some good things, but we're still severely underperforming the broader market there, and the stock is still struggling. So still some answers, I think, that we need next year.
Yeah, at the very least, we know that the activists want the stock price to go up.
Exactly, yes.
I think that one's pretty simple. Allie, thank you so much. Appreciate it. Well, Amazon could be solidifying itself as a major player in the AI arms race. The tech giant announcing a new artificial intelligence chip, as well as a strategic collaboration with NVIDIA today at the reInvent conference in Las Vegas. Here with the details, Yahoo Finance tech reporter Dan Halley. This was such an interesting story because it's coming out with a new version of its chip, but it said, but we're still besties with NVIDIA.
Oh yeah, don't
both.
Yeah, it's talking out of both sides of their mouth. And look, all companies are doing this right now, right? You have Amazon announcing 2 chips, getting to that in a sec. Microsoft announcing its own chips. Meta might not be anymore working on its own chips. Google has its own. So they're all doing this. They're all playing the same game. We want to be besties with you, NVIDIA, but we're also just going to do this on the side. So let's talk about what Amazon's doing on the side. They announced 2 new chips today. It's the Graviton 4 and the Trainium 2. Real sci-fi sounding names. Imagine there's a lightsaber in there somewhere. The Graviton 4, Amazon says that's 30% better computer performance, 50% more core, 75% more memory bandwidth, yada, yada, yada. Long story short, it's a better chip than the Graviton 3, which they had already had. Basically, this helps power AWS instances. If you use AWS, you're going to use a Graviton chip, depending on the application, but more or less, you would use that. So Graviton 4 meaning better performance overall for AWS. That's good for their customers because faster is better. The Trainium 2, though, is an important chip here because this is where you get that kind of weird mix-up between them and NVIDIA, who's using what you're going to use. So the idea here is that this is supposed to be better for training, better for large numbers of chips. They have what's called an EC2 Ultra Cluster. They said that has up to 100,000 chips involved in it. Basically, it's great for training foundation models and large language models. And the important thing here saves on energy efficiency, which, when we talk about these things, we're like, oh, all these chips, it's great. Not really. They take up a lot of energy. It takes a lot to cool them, takes a lot to power them. That's a huge drain on resources for companies, as well as not necessarily great for the environment when they're all talking about how they want to be environmentally friendly. But I digress. The big thing here is, yes, they're working on their own chip, but they're also working on NVIDIA. Why are they doing this? It really comes down to customer choice. They want to be able to say to a customer, do you want to use the NVIDIA chip? Do you want to use an AMD chip? Do you want to use our chip? Which one makes more sense for you? And perhaps one is more expensive than the other. The NVIDIA chips themselves are tens of thousands of dollars. So for a company to purchase those and then recoup that cost, you're going to have to rent that out for a little bit more money. So the development of their own chips, also incredibly expensive, but then to be able to say, look, hey, we're not NVIDIA, but you can save a little bit on that energy, and that'll help you as well. Right. So they're really doing two things at the same time. It's not at odds to be doing their own chip as well as NVIDIA chip. People want choice.
And that wasn't the only headline too, Dan. They announced this new chatbot Q. What's the story with there?
We Jared Blickery pointing out Q, the Star Trek character.
Yeah.
Yes, he was.
Was he real or was he an AI? Now I can't even
That's
remember.
Was he an alien? I think he was an alien. My friend's a huge Trekkie. If he sees this, he's going to punch me in the face. But he was in the very last episode of The Next Generation, which is an excellent episode. Now I hate myself. This is a chatbot.
I love you, Dan.
Thank you. I appreciate that. This is a chatbot for businesses themselves. So it's not going to be something that you can jump on like Microsoft's Copilot, formerly Bing Chat, or Google's Bard. This is something that businesses are going to use to help develop their own Copilots, their own applications. They're going to basically load it up, or it is loaded up with Amazon's own AWS data, so it's trained on that information. And then you can take what you have and run it through that. So if you have to ask it questions, if you want it to do a specific task for you, you can do that in plain English. You don't have to be a techie to do it. Interestingly, they were poo-pooing OpenAI for a second. Our Ali Garfinkel, who was there covering this, was excellent to point that out. They said you don't want a company that relies on one AI business, so basically needling Microsoft there. But Amazon's product is essentially what Microsoft is already offering with their various copilots. They're trying to provide the same kind of service for AWS. The reason being, this provides a bigger landscape for customers to jump on. And so if Microsoft is doing it, and you can see the growth that they're getting out of this, Amazon has to get on it because growth at AWS has been a big issue for them, especially since it's got the best margins for the business. So the fact that they're adding this makes complete sense. You can expect them now to really start pushing this. And you would expect analysts to be asking about it on the next earnings call. AI has been all that people can talk about in 2023. We're in almost December. It's not going to go away next year.
Yeah.
Just because the clock strikes midnight on the 1st or on the 31st doesn't mean that AI is going away. It's going to continue to rock and roll for these companies.
Yeah, I mean, you can look at Microsoft, Dan, to your point. I mean, they commit to putting like $10 billion to OpenAI, right? And that stock rips 60% this year.
Yeah.
That's
Amazon and Anthropic, it's,
Yep.
who's going to win? It's really fun.
Dan, thank you for joining us. That was great. Appreciate it. And coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
Less than 60 seconds till the closing bell on Wall Street. And here we are at the Wi-Fi Interactive looking at the intraday action for the Dow. It's up 0.25%, not huge action in today's session. But we also have been looking at some of the movers in the Dow. We were just talking about, interestingly, Airbus with Jennifer Grancio of TCW a little while ago.
Who's a fan?
Boeing, she's not a fan of this one,
No.
Boeing, by contrast. But this did get an upgrade today over at RBC, and the stock's up 1.4%. So one of the movers that we're watching within the Dow today. If you equal weight them, it's an interesting look at the movers there. Triple M also up today, 3M, catching a bid.
Nice.
Yeah.
A little green there for 3M.
Yeah, a little green for 3M and for the Dow by extension on the session. Why don't we do a quick check on the Nasdaq 100 as well? There we see much more of a mixed picture within technology today. And there's the closing bell on Wall Street. Looks like Wisdom Tree is ringing the bell today. Another sort of, it was interesting. I was reading some research from Bespoke Investment Group this morning, who pointed out, of course, one would expect to see low trading volume last week, particularly on the shortened day, trading day on Friday. But they were also noting that trading volume remained low on Monday of this week, which is less typical, right? You would tend to see people coming back. It looks like just glancing at trading volume versus the 100-day average, it was lower for the Dow today, about in line for the S&P 500. So some of that trading volume perhaps coming back here as we close out the session.
All right, let's get some movers here as well. We're going to start with Twilio ending the day higher. It's after news that activist hedge fund Anson Funds is reportedly building up its stake in Twilio, worth about $50 million. That's according to the information. The fund reportedly sent a letter to the software company's board, urging it either to sell the entire business or divest from its data and applications unit. So this is courtesy of report in the information, Julie. The fund suggesting, listen, also, we should note, not only making these suggestions, but also seeming to hint here it could launch a proxy fight if Twilio doesn't act. Twilio, communication software company, it is up about 30% this year. I think it's trading around 65. It was around, of course, 435 back in 2021. Company we know, listen, they have been making some moves under CEO Jeff Lawson. They cut costs, layoffs, sold off 2 business lines. So we'll see where this fight leads.
Yeah, we will see where this fight leaves. I mean, Twilio has been, I don't know, I feel like it's one of these companies that has been volatile, and I guess the stock chart kind of bears that out, right? Yep. In terms of the perception of the company. It has risen 38% this year, so it's not sort of the classic, beaten down name that then an activist jumps in to take a look at. This one has actually done a little bit better here. So
at least year to date.
Yes, at least year to date. Although I guess if you look at the longer term, that's not necessarily the case.
Not as pretty.
No. We are also watching shares of GameStop. It was jumping today, up 13%. The meme stock getting some attention from investors, even as Roundhill's meme ETF is it recently was set to liquidate in December here. But GameStop kind of caught our eye. It was the top trending ticker on Yahoo Finance Day, so it also caught investors' eyes. This was the biggest single day gain since June 13th. There's nothing going on that we could see.
So we can't pin it to a headline.
You can't pin it. I mean, it's not unusual that you can't pin it to a headline. When it comes to this, it has become more unusual as of late. GameStop hasn't seen this sort of necessarily kind of movement, so that's why it caught our eye as well.
All right. You see the movie Dumb Money? Did you catch the GameStop movie?
Did I see the movie? No, I haven't seen that yet.
You haven't?
No, I'll have to check it out. But the company does report its earnings on December 6th, and that it is interesting, sort of as a corollary to that meme ETF is going to be liquidated. Roundhill, brought out that ETF at the height of the craze or shortly thereafter, trying to capitalize on the retail enthusiasm, but seemingly the retail enthusiasm has sort of died off. So that ETF is going along with it. There's also another one called Buzz, the VanEck Social Sentiment ETF. That one hasn't gained that much attention.
Whenever we talk GameStop, I just feel immediately transported back to sometime in early 2021.
Yeah.
I mean, it was literally everything. I mean, it was everything everyone was talking about. It goes from 18 to nearly 500, then back to 50. So I feel like a few people might have been might have lost a few bucks along the way.
Yeah.
That's what that move suggests. All right, moving on. A dovish tone from Fed Governor Chris Waller driving rates lower in today's trade. Markets are pricing in that the central bank is done raising rates. Our next guest sees the Fed starting to cut rates next year, and sharp ones. Joining us now is Deutsche Bank senior U.S. economist Brett Ryan. Brett, it is great to see you. Let me just, start here, Brett. Your big picture view. 2023, Brett. Obviously, the economy proved a lot more resilient than certainly what a lot of economists, strategists, investors thought. As you look out at 2024, Brett, what's your outlook?
Yeah, sure. So thank you for having me on the program. And, with respect to your first question on, 2023, there are several reasons why the economy outperformed. Labor market was certainly much stronger. Fiscal policy was a mild boost this year that was unexpected. And really, the consumer headwinds haven't really picked up just quite yet, but they are, and they're still set to hit. Bank lending to consumers is at recessionary levels. You have delinquencies and credit card and auto loans that are really back or well above pre-COVID. And you have student loan payments now coming back in the fourth quarter. At the same time, you have business spending that's slowing. So we expect a mild recession, continue to expect a mild recession in the first half of next year, with 2 quarters of negative GDP growth and the unemployment rate moving up to 4.6%. And that's what prompts the Fed to start cutting more aggressively starting at the June meeting next year.
And I thought it was interesting in your note that you really did go back and say what happened in 2023. I'm really curious, and I've been asking a lot of folks this, kind of what lessons you learned from that exercise and from a year that really didn't turn out like a lot of people expected.
Sure. I think one of the things that was underappreciated was that, and that was a surprise, was really what happened with tax receipts and fiscal policy. You had bracket creep that resulted in large tax payments in 2022 that sort of reversed in 2023. So people had less withholding that resulted in sort of weakness in consumer spending in the first half of the year, but a bit of a comeback in Q3. You also had the employee retention credit that was unexpected. And those are a couple of things, but really the labor market, the strength of the labor market to this point was really surprising, I think, and especially labor hoarding. And one of the ways to think about it is, you have the quits rate, which is back to pre-COVID. You have the hiring rate, which is slightly below pre-COVID, but the layoffs and discharges rate, that's the standout here, and that's still at its lowest point in history, really. If you were back to the 2019 layoffs and discharges rate, we'd be close to printing flat payrolls at this point and possibly negative.
And so, Brett, just sticking with the labor market, so I'm just curious what you see for the labor market in 2024, Brett. I mean, there's been signs of cooling. Do you see further deterioration there?
Yeah, so, to date, through October, 70% of the job gains have been in just 2 sectors, and that's in private sector job gains, and that's leisure, hospitality, and healthcare and social assistance. Those are the 2 sectors that, not surprisingly, we're still trying to get back to their pre-COVID trend. But other sectors of the economy, the rest of the job market looks less strong. And the diffusion index for payrolls is now, towards the lows of the last cycle. We continue to see a slowdown going forward, and that's really driven by a slowdown in consumer spending beginning in this quarter. So you had a really strong Q3 that was surprising. Some of the high frequency data points to a sharp slowdown recently. We think that'll continue into Q1 and Q2. And again, that labor hoarding scenario can only last for so long without a demand upturn and demand coming back.
And Brett, you guys are also looking for 175 basis points worth of interest rate cuts from the Fed, starting in the middle of the year and then going from there. That feels a little more aggressive than some of the other predictions that we've gotten. What's the sort of primary differentiator, do you think, in your outlook versus some of the others that's informing that?
Yeah, absolutely. So it's really, again, when the unemployment rate's getting north of 4%, and particularly like 4.5, 4.6, that brings the other side of the dual mandate back into the equation for the Fed. And so it also increases their confidence that the economic, outlook environment, you have a loosening of the labor market that takes pressure off wages. And so that gives them the confidence that they can sort of cut more aggressively, getting back towards a more neutral rate of around 3% by early 2025. And again, we think neutral, the nominal neutral is around 3 versus, the Fed's 250. So it's really all about the deterioration in the labor market, the weakness in the first half of the year, and that allows, the inflation outlook to come down for them, and they can feel confident they're on track to get back towards target.
Brett Ryan, thank you so much for joining us today, Brett, and for that insight. We appreciate it.
Thank you for having me on the program.
And some breaking news here. Berkshire Hathaway Vice Chairman Charlie Munger has died at 99 years old. The company announcing the news in a press release saying he died this morning at a hospital in California. Berkshire Hathaway CEO Warren Buffett saying in that release that Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation. Julie.
Yeah, just an absolute titan within the investing world, really alongside his longtime partner and friend, Warren Buffett. He was set to turn 100 on January 1st of 2024 and was very active as a 99-year-old speaking. Just coincidentally, my husband happened to have listened to a podcast that he was just on. So was very actively giving interviews, speaking publicly, even at 99 years old. Both he and Buffett viewed as very sharp still into their later years, even as they were leading this amazing investment company together. So really it is quite a landmark within the investing industry that Charlie Munger has passed away. And maybe not something unexpected given his age, but nonetheless really a remarkable life, both as a man who was always very outspoken and also as an investor.
Yeah, there were a lot of investors and financial leaders and business leaders who looked at Charlie Munger for advice, for guidance, for insight. The Journal has a great piece on that, talking about how he used to host these kind of weekly Friday lunch clubs, is what they were called, and periodic dinners. What's remarkable about it is you go through a list of people who would attend these Friday lunch clubs with Mr. Munger, and it's just a who's who of entrepreneurs and business leaders. It's John and Patrick Collision, of course, founders of Stripe. It's Bobby Kotick, CEO of Activision Blizzard. It's Howard Marks, well-known, well-respected co-founder of Oak Tree Capital Management. Such a wide range of people from a lot of different backgrounds all would go to just listen to Charlie Munger speak about the markets, the economy, his thoughts on investing. I think it just tells you everything you need to know about how well-known he was and how well respected he was across a lot of different disciplines.
Yes, most definitely. Well, we will have much more on this. Of course, I'm sure that there will be many remembrances of Munger pouring in, and we will share them with you. We'll be right back. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The big wake of cloud earnings rolling on here. Intuit and Workday just reporting moments ago. Intuit's adjusted earnings beating expectations, coming at $2.47 per share versus $1.98. And net revenue also topping Wall Street's estimates. As for Workday, third quarter adjusted EPS coming in at $1.53 versus $1.40. And revenue came in just above the estimate. Joining us now is Mizuho managing editor Siddhi Panigrahi. So Siddhi, listen, you're the perfect one to talk to. You cover both these names, and at least initially here, investors seem to like what they heard. Maybe start with Intuit here. I know you're a believer. You've got a buy on the name. What did you make of that report?
Thanks for having me here. Look, Intuit results kind of address right now some of the concern about small business spending. It's really a strong quarter. Investors are a little worried about small business spending, and they deliver really a strong quarter. I mean, the beat came even from that consumer business, small business, as well as Credit Karma, which is slightly better than expected, although it is down 5%. So overall, I would say it's a good quarter to, a signal that, they're executing well. And of course, on the earnings side also, it's pretty good. Margin was well above expectation. Margin was 32% versus consensus expectation was around 27%.
And Siddhi, there are some analysts on the street who say, listen, Intuit isn't, immune to the macro, but I know some argue it's better positioned than perhaps some rivals and some peers because of its tax and small business segments. Do you agree with that call there, Siddhi?
Look, I feel that Intuit is one of the essential, mission-critical application for small business. So small business run on QuickBooks, Intuit QuickBooks. It's not an expense line item. So even in this any kind of macro environment, you still need QuickBooks. So that's why, a company always say that 20% of their, small business segment revenue only exposed to macro. Remaining 80%, it's pretty solid. And they prove that it's resilient. They're resilient business even in the small business side. And consumer, as you know, the tax is always defensive. Like they say, death and taxes are certain. So it's a pretty defensive business.
I want to ask you a little bit more about Workday as well. That stock is up a little bit more after its numbers. It raised its subscription revenue forecast for 2024, which seems to be helping matters as well. Talk to us about the Workday customer, right? And how, obviously, they're doing different services for different businesses. But, what are they seeing in terms of demand right now?
Yeah. So look, Workday, they're the leader in cloud human capital management application, and they have extended their success in HCM to financial and other applications. And that we are seeing that. I think one of the key points of this earnings is their 12-month subscription backlog number that they disclosed this time, which is almost 22% year over year. That is a pretty good number. What we are expecting. And they continue to do well in terms of cross-selling their finance, procurement, expense management, and other applications to their strong human capital customer base. So they're executing well with new management, new CEO, new CFO. I think the company executing really well.
And Cindy, when it comes to Workday, how does the competitive landscape look to you right now? Are there win rates stable versus the likes of Oracle?
Look, I think at this point, when it comes to HCM, they are the leader in the cloud HCM space. Yes, of course, on the ERP finance side, they are competing with Oracle. Oracle has put together a cloud ERP application. They see competition with that, but remember, there are so many legacy applications that are switching, so it's not a winner-take-all market. So Workday has definitely opportunity to win also at certain instances.
And Cindy, again on Workday, I'm interested. Obviously, we talk a lot about the boom of interest in AI. How are they leveraging that technology right now, Cindy? And are you impressed by how they are leveraging it?
Look, Workday, even before we saw this excitement about generative AI, Workday has been investing on AI platform. And they have right now leveraged AI to build some of the tools in their, talent management applications, so Skills Cloud and some of the other applications they talked about. Well, we'll see how the adoption takes place, but I think they are in a pretty good position right now to deliver some kind of AI-based tool. But at this point, too early to say any kind of adoption. We'll see in next 1 or 2 years how the AI adoption takes place.
Siti Panigrahi, thank you so much for your time and insight into these names. Appreciate it.
Thank you. Thanks for having me.
We got much more market action coming up. You're watching Yahoo Finance. We're just a couple days out from COP28. That's the summit that aims to bring together world leaders and organizations to tackle the issue of climate change. And it comes as the investing community here in the U.S. has continued to pull away from what has been labeled environmental, social, and governance funds, that's ESGs. The labels become increasingly criticized and politicized, posing the question, where should we look to invest with the planet in mind? To unpack this is Tariq Fancy, who was BlackRock's first CIO for sustainable investing and an independent financial analyst. Thank you so much for being here. We thought the timing was good to look at these issues. And I would start with COP28 and whether we think anything's going to be accomplished there, particularly if you're looking to invest in some of these ideas.
Well, thanks for having me. I think, COP28 is probably going to be an interesting opportunity to sort of test a new thesis. And I think one of the theses here that question is, having an oil country actually host the summit and appoint the head being sort of the head of their oil company. I think that'll be an interesting opportunity to see broadly how you can sort of build a broader coalition, including with fossil fuel players. In terms of new investment ideas and vehicles, I think the most interesting ones that people are hoping for are mechanisms to address the gap of capital for emerging markets. So there's something, the estimates range around over $2 trillion a year needed for emerging markets to build, to continue to develop as they're doing their growing economies, but also to do so in a way that builds a cleaner energy system and sustainable infrastructure. And those present long-term investment opportunities for capital providers in rich countries. But we haven't really seen that gap get bridged yet. There aren't really any vehicles for people to be able to do that. And I think one of the big hopes is that you start to see that, we square the circle on that and start to figure out, new ways to actually build that. And, and those create real world impact and they're attractive investment opportunities if structured correctly.
And Tariq, what did you make? I got to ask you of these reports that President Biden won't be attending the meeting.
It's hard to say what the reason is. I mean, I think that domestic politics probably not something that's really that exciting for him to go to. I'm not sure he's going to win a lot of votes versus, sort of having a little bit of, not almost a backlash, but I don't think it's something he needs to actually do and be at. And I think with everything else going on with, Israel, Hamas, and sort of the reverberations around the globe, the president doesn't have to be there. And so I think it would have been better if he's there symbolically, but I don't think it's a big issue that he's not.
So I want to ask you more broadly about ESG and whether you think the problem is with the label and the branding or with the fundamental idea of it. When we talked to Jennifer Grancio earlier on the show from TCW, who was at Engine Number One, and she said, ESG was never meant to be sort of a fun description. It was meant to be just a way of measuring. What do you make of sort of what's become of it?
Well, it's interesting. I mean, ESG in general, even at a place like BlackRock and all big firms, it's sort of two things, right? It's a set of tools, right? Additional data and frameworks that you implement into existing investment processes in theory, because, you can understand risk and return better. But it's also lent itself to a set of new funds and products. Generally speaking, the industry has been really focused on new funds because you can gather assets at higher prices. But I think that's the part that's gotten kind of politicized, right? Because your average ESG fund, if you actually dig underneath the, what they're arguing is going to happen and where money gets made, they usually have a set of theses around ESG that align with what progressives want, right? So the E will say climate change is bad, you need to lower emissions. The S will say, diversity is amazing, you should add diversity. And leaving aside sort of whatever you think about that investment thesis, they kind of lean towards progressives. And so now you've seen anti-ESG funds come from the right. And I think sometimes the distinction between the tools and data that are just a process enhancement, which I think probably Jennifer Grancio was referring to, that is different from fund ideas. And they get conflated and they often get, both get politicized, even though really using additional data in an investment process isn't something that should be politicized, because if it's not useful, you don't use it.
Tariq, let me ask you this. Let's say you're an investor, you're listening to this right now, and you care about climate change, you care about reducing emissions. Where do you think investors could and should invest then in the public markets?
Well, I think so. One of the challenges with ESG also is that it kind of promises all things to all people, right? Is it about better returns? Is it about real world impact? To answer your question, right, what creates real world impact? I have money to spend and I want it to actually back something I think is good for the world. generally speaking, the best investment opportunities along those lines tend to be private vehicles, right? And the reason is that they have additionality, because you can make the argument that if you didn't invest in that climate tech VC fund that backed some new carbon capture storage idea, or even a private equity deal that was scaling or a scaling infrastructure or those types of things, if you didn't make that investment in that private vehicle, you may not have actually seen the fund investment ever happen, and the world wouldn't have seen it. That's where the real opportunity is. But so far today, there aren't that many funds that the average person can invest in that actually align around that. Most of what we're seeing in ESG are public markets funds, right? They're just moving around baskets of already traded, secondary shares. The challenge with those is that those are where most of the opportunities are today. They're unfortunately where most of the greenwashing is, because the average person buys it and thinks that their capital is going towards that cause. In reality, it probably overweighted Microsoft or other tech companies to lower their carbon footprint. And Microsoft hasn't issued shares since the 1980s. So the reality is that I think most of the funds that rushed into ESG very early on, public markets, secondary, shares created, don't have a lot of real world impact, but they are the easiest things for people to invest in. And unfortunately, probably the places that the greenwashing impetus is the greatest. I think we'll start to see more vehicles coming in the next few years that actually give people access to innovation, sparking kinds of real world changes and infrastructure being built that we haven't seen yet.
Tariq Fancy, thank you so much. Appreciate it.
Thanks for having me.
I wanted to reiterate that breaking news that Berkshire Hathaway Vice Chairman Charlie Munger has died at the age of 99. The company announcing the news in a press release saying he died this morning at a hospital in California. Berkshire Hathaway CEO Warren Buffett saying in the release, quote, Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation. Our head of news, Miles Udlin, who went, of course, frequently to the Berkshire Hathaway shareholder meeting, is here with us now. Miles, obviously a very close partnership between Buffett and Munger, and really Munger providing a vital role in Berkshire Hathaway. Talk to us about some of your impressions.
Yeah, I mean, I think, when you look at the arc of Berkshire Hathaway and you think about the changes that it has gone through as a company, starting as an investment partnership, taking over that failed factory in, textiles factory in Massachusetts, to what it is today, Warren Buffett himself would really attribute a lot of those changes to his relationship with Charlie Munger, most famously Charlie getting Warren to drop the cigar butt thought around how Berkshire goes about its investments. Basically, when when Warren began his investing career, he's thinking, well, let me just find anything that's undervalued. Let's call it a company that is trading for less than the value of its cash in the stock market, right? Very simple Ben Graham type principles. And that can work when you're managing tens of millions, even hundreds of millions of dollars. But when you've got hundreds of billions of dollars at your disposal, you need to think in a different way. You look at the investments that Berkshire's made in Apple over the last few years, the way that has really changed the portfolio. It really has changed, Berkshire's approach to how it creates value for its partners, for its shareholders, which, Warren and Charlie are some of its largest. And a lot of that thinking, that approach, Warren really attributes that to Charlie prodding him to think a little bit differently, be a little bit more, I don't know if creative is the right word, but realize that, you are probably not, you, Warren Buffett, probably were not just the humble stock picker from Omaha, right? You're a unique genius who has some kind of edge, can see things in the market that people can't. And ultimately, Charlie was kind of the muse that Warren needed over the years to really get him to think differently about his own approach, and certainly that kind of back and forth the two of them had defined so much of what has happened at Berkshire Hathaway, which in the public's eye is most closely associated with Warren Buffett. But Buffett would be the first to tell you that the Berkshire we know today would be nothing without the contributions of Charlie.
And Miles, just thinking about Charlie Munger too, also of course well known for his one-liners. He was not shy about his opinions, likened bankers to uncontrollable heroin addicts, was very blunt about his opinion on Bitcoin, called it rat poison. I'm interested, when you think about this relationship, Miles, and this news, what do you think the future of Berkshire looks like?
Well, the last several years have been interesting at Berkshire Hathaway in terms of the preparations that they've made for sad days like today. They've installed 2 additional vice chairmen alongside Charlie Munger. They've now got Ted Combs and Todd Weschler running the investment portfolios alongside Warren Buffett, of course. And so the Berkshire that we see today with the structure of Greg Abel and Ajit Jain as vice chairs alongside Ted, Todd, and Warren now is one that has been ready for the unfortunate and sad day that Warren and Charlie certainly candidly knew. They talked about this day coming at recent shareholder meetings. And so it is not a position where there's now a scramble to figure out what happens at Berkshire. The way that the company is going to be run as this era comes to a close, this is part 1 of 2, has been established. And I don't think is going to come as a surprise to shareholders. Certainly Berkshire shareholders know what these plans are. I think investors at large, the market at large, knows what this Berkshire Hathaway has become, how it got here, and what I think Warren and Charlie hope it will be for decades to come.
One of the other things I wanted to mention, is sort of the Munger Buffett legacy when it comes to charitable giving, right? I find it interesting that Munger was one of the creators of the Giving Pledge, but he didn't sign it because he had already given away most of his money. But that's also, I think, something that when we think about these sort of elder statesmen of the investing world, that was also something that was very important. I mean, one of the things that we also talk about with Munger and Buffett was fairly modest lifestyles, right?
Yeah, I mean, remember, Charlie Munger is a lawyer by trade. He was a lawyer for many, many years before he joined Warren Buffett at Berkshire Hathaway. And he and Buffett both gained a disproportionate amount of their personal wealth later in life. I think the pop culture now is still defined, right, by The Social Network, by the Wonder Kid billionaire founder. And we have a lot of, Jeff Bezos is in his 50s, Elon Musk is in his late 40s. Like, these are the richest people on earth who have a long time to live. That was not the case for Warren and Charlie. And they, came to this fabulous amount of wealth later in their lives. And I think as a result became singularly, you could almost say singularly, but I would say hyper-focused on giving that wealth away, what they were going to do with that money. Because I think, unlike perhaps the hubris of a wonderkind who comes into hundreds of millions, billions of dollars early in life, you think that you've done it. And I think Warren and Charlie's, wisdom ultimately, I think why it kind of speaks to younger investors, why thousands of people go to Omaha every year, is because everyone will say, well, luck plays a big part in it. But I think they both really believe, they saw that. They were on different trajectories in their own lives as investors, as lawyers. They started in Omaha. Charlie finished his life in California. Warren still is in Omaha, right? They didn't change too much over those years. And I think as a result, to your point, Julie, like, they had a vision for what they were not going to do with their money, go to Mars, things of this nature, right? They knew that it was a matter of happenstance that they came into billions of dollars for themselves. And I think had a real humility, not just a word, like an empty word kind of humility, but an action-oriented humility around, that's not my money. That's not my money to keep. And I'm going to have a plan to give it away, not only while I'm alive, but certainly after I pass.
Miles Edlund, our head of news, with some reflections and perspective on Charlie Munger. Thank you. We'll be right back. Berkshire Hathaway Vice Chairman Charlie Munger has died at the age of 99. The company announcing the news in a press release saying he died this morning at a hospital in California. Berkshire Hathaway CEO Warren Buffett saying in the release, Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation. For more perspective here, we have Cole Smead, Smead Capital Management CEO, and George C. Annandale, Capital founder and chairman. Cole, I want to start with you. It looks like George's getting set up there, so I'll start with you here. I feel like you were raised on Berkshire Hathaway and sort of the philosophies, the value investing philosophies of these guys. Is that fair to say? I mean, I think of your father as a value investor who closely followed these. I think of you and your firm as closely following this kind of philosophy. Kind of talk to me about your perspective here.
Yeah, it's a great question. Thanks for having me. I really consider Charlie Munger to be like my patron saint from a worldly wisdom perspective. That's something that Charlie often talked about was worldly wisdom. Understanding and studying the ways of the world. And I think what Munger reinforced time and time again is the idea that here we are on Earth, all we're really doing is learning to learn. He talked about using multiple models in how you think about things. It's an interdisciplinary world that we deal in because it's so complex. And I just think you'll rarely find someone like Charlie who wanted to read so much, who wanted to learn so much. I think one of the things that he just kept it simple in such a unique way. He would make statements. Your prior colleague was commenting on his statements, his one-liners. But what his one-liners really did is they cut to the heart of the matter and spoke truth all at the same time. Most people usually have two problems with doing what Charlie does. One, they don't know the truth. Second, they don't want to tell other people the truth. And I think that's what Munger's unique opportunity was in society, beyond all obviously the personal financial success he had. And to your point on what Berkshire has evolved with Charlie, you cannot replace a Charlie Munger in any way, shape, or form, nor do I think you want to. The question for Berkshire will be, how do they have to evolve with the talents and the gifts of the people that they have around them today? Because you can't replace them.
And George, I want to bring you in here as well and just get your response to this news, George, your reaction to the news of Charlie Munger's passing and what kind of impact as well he had on you.
Yeah, thanks for having me on. It's a real privilege to get to talk about Charlie Munger. I have a real distinct memory from April 2000, right after the tech bubble started bursting, and Berkshire Hathaway had gone straight down in a straight line about 30% from where it had peaked when they bought General Re. And I'll never forget me and Franklin Delano Roosevelt's great-grandson and one of my best friends who's a hedge fund manager in California managing several $1 billion. We got there at like 5 a.m. to go to the annual meeting, and it was the lowest attended annual meeting since then, and even before then for many years, because his investment philosophy and style, both Munger and Buffett, were so out of favor. And we got down there on about the 4th row, and I'll never forget watching Warren and Charlie eating their dilly bars and drinking their cherry cokes, et cetera, and having all these 20-something-year-olds go, I made over 100% last year. What's wrong with you guys? You guys are totally out of step, and you'll never recover. And they were so polite to these young people. They were professional, respectful, polite. It made a real impact on me on the character of these men and how well they conducted themselves. And being a Texan, I'm really admiring of how blunt Charlie Munger was. He was such a blunt, to the point, no nonsense man. And I feel like that's kind of an old California persona that we're starting to lose people who respond like that. And we Texans love bluntness. So he was super special. And I don't think you can say enough of that. They just don't make them like that anymore. One more thing that most people forget, Charlie Munger was a brilliant attorney. I mean, he wasn't just a great investor with Buffett. He was a very accomplished attorney. So he was kind of a Renaissance man. He was good at a lot of things.
And talk to me a little bit more, George, about his legacy. I mean, when you talk about, there aren't a lot of investors like this anymore, but what do you think sort of the lasting legacy of Charlie Munger is in terms of the effect on how people think about investing?
Yeah, well, I think he taught people a lot of patience. I mean, he just held Berkshire stock for so long and was very patient in watching an investment thesis play out. And these days, we're in the 30-second soundbite, and you see in movies images flash before your eyes every couple of seconds. And it's kind of a I want it now kind of generation. And so that kind of long-term thinking, which is so wise in investing, people should follow his example and not turn into day traders again or try to rush in and out of investments. And also, you have to really have a huge amount of gratitude to him and Buffett for creating literally hundreds of thousands of American jobs. I mean, if you look at all the impact Berkshire Hathaway has had on our country and the good of our country and the good of our families around the country and people who need to work, it's just you can't overstate it. It's tremendous.
And Cole, there's a statement here from Warren Buffett as well saying Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation. What do you make of that statement, Cole? And what do you think Munger taught Buffett? How do you think the impact and influence he had on Warren Buffett?
Yeah, well, there's kind of two eras to Berkshire Hathaway. There is, to your colleague's comment earlier, there was the Ben Graham era to Berkshire Hathaway, which was, what Buffett had learned from obviously his mentor Ben Graham, and the idea of triple nets and really, buying securities in aggregate that were cheap. And Munger not only helped Buffett focus on the kind of businesses he wanted to own, but obviously the quantity of businesses he wanted to own. Munger was quoted for saying, put few eggs in the basket and watch the basket. In other words, the idea that you actually take less risk with fewer investments than you do by taking more, which, as Munger often said, was antithetical to what's taught in business schools even today. And so I think those kind of principles were really the second half and second act of Berkshire Hathaway, where Munger was not only teaching people about how to deal with risk, but then also the quality of businesses he wanted to deal in. The Coca-Colas, for example, that came later, the See's Candy, which they talked voraciously about from their investment in the 1970s, which was a turning point for Berkshire Hathaway at that time. So I think that's really important. But let me add one more thing. Don't forget that, people want to go out and do great things in their life. And Munger pointed out that you don't do great things in your life. Most of success in your life is not doing stupid things, or what he called ignorance avoidance. So you want to have a great marriage. Great. Don't do stupid things. Practice ignorance avoidance. You want to run a great business. Yeah, don't do the stupid things. And I think removing the negative, it's a negative art that Munger was really trying to have us understand. And by removing that negative, it allows for a lot of positives to come to our life. And again, we're terribly indebted to him for his thinking because, again, Warren would not say it like that. Charlie said it in a way that connected with you. And what a blessing to us all.
Don't do stupid things. That's a simple, important life lesson. George, I want to end here with you. You know Berkshire well. I'm interested, George, what you think the future of Berkshire looks like.
I think the future of Berkshire is exceptional. I do think there will be people calling for it to be broken up and pieces sold off once Mr. Buffett passes away. But I hope they keep it all together. It's a very unique American institution, really, not just a business, but institution. And it's brought so many blessings to so many different people. And I think the future's bright. And I think whoever takes over as the CEO, probably the guy who runs the power division, they'll start buying back even more stock. I think they'll buy back gobs of stock, and I think that stock will perform extremely well for a long time to come. And I want to add to my colleague's comment about quality. Munger really did impact Buffett significantly like that and pulled him away from Ben Graham into growth at a reasonable price and buy great businesses at a fair price kind of mentality. And if only Buffett had bought Costco, you think about how big the investment portfolio had been if he bought it when Munger first bought it. And I also, one other thing that Charlie said that I think was so wise is hang around with the very best people. Don't waste time with people who are toxic, negative, dishonest. Just stay away from those people like the plague because they can ruin your life. And he was very successful at running around with great people, Buffett being the best example.
All right, thank you so much, guys. Cole Smead, Smead Capital Management CEO, and George C., Annandale Capital founder and chairman. Thank you both.
Great to be with y'all.
And coming up, what to watch tomorrow, we're going to break down these stories you need to know to start your day.
We are watching shares of Las Vegas Sands after the company said its largest shareholder was looking to sell $2 billion worth of the stock. The company says it will not receive any proceeds from the sale. By the way, the largest shareholder here is Miriam Adelson, of course, who is the widow of Sheldon Adelson. She owns, I think, 56% of the company. So $2 billion worth of the company stock would be about 10% of the stake. And the company saying in a statement that she's interested in buying a sports team, although we don't know, or a stake in a sports team at the very least, although we don't know which one.
Yeah, so it sounds like they're not going to. They wouldn't receive any proceeds from the sale of shares, right? So, but it has been advised per Dow Jones that the selling shareholders, that they currently tend to use the net proceeds from the offering as well as cash on hand to fund the purchase of majority interest in a professional sports franchise. But we don't know which one, to your point, Julie. Stock moving in the after hours, but year to date, it's basically
not done much of anything.
Dead flat here, down about 1%. Although I will say on the street, 14 buys and 0 sells. So some bullishness, at least among the analysts.
Yeah, some of the company's fate has been bound up, even though it's called Las Vegas Sands, it still gets a lot of its revenue from Macau in China, right? And there's been sort of a bumpy reopening of gambling in Macau. And of course, there are questions about the robustness of the Chinese economy. So that has inform the performance here. So unclear how sustained an effect this would have on the stock. It seems like if it's falling, this is sort of a technical effect of her selling these shares. It's just sort of an interesting story here. Adelson was a big figure in Las Vegas in politics as well. And Miriam Adelson, who according to Forbes is the 5th richest woman in the world. There's a lot going on with Las Vegas sports and some teams moving around.
Yeah,
and I don't know what she's a fan of. I guess we'll find out.
We'll hopefully find out. That's the big question. Which sports team?
Yes.
That's what we want to know.
That's the big question.
All right, time now for what to watch on Wednesday. It's another busy day for earnings. Ahead of the open, we're going to hear from Foot Locker and Dollar Tree. And after the close, the big ones, Salesforce, Snowflake, Okta, they're on tap as well. Investors will be looking for a sense of the health of consumer going into the holiday season from Foot Locker and Dollar Tree, as consumer sentiment has trended downwards in recent months due to the high rate environment. Foot Locker getting 2 downgrades in recent days ahead of those results. Salesforce's guidance for the current quarter will be scrutinized, of course, by the street, with Goldman Sachs analysts noting this period captures when customers decide on renewals for next year's services. And on the economic front, the Fed will release its Beige Book, which will give a sense of the state of the economy. Today, Fed Governor Michelle Bowman said rates will have to rise to tackle inflation, while Governor Christopher Waller spoke of confidence in the current level. And tomorrow, we're going to get the latest read on GDP as the second estimate for Q3 will be released. The previous reading saw an annual rate rise of 4.9%.
Well, that does it for today's Yahoo Finance Live. Of course, we will be talking much more about the life and legacy of Berkshire Hathaway Vice Chairman Charlie Munger. Among those commenting, Brooks CEO Jim Weber saying to Yahoo Finance, calling him wisdom personified, which I think is in line with some of the other commentary
it's a nice way to be remembered.
We have been getting. Charlie Munger, dead at 99.